Let's talk about making money with stocks. Without waiting decades or staring at screens all day, there's a middle ground: swing trading. Imagine a stock moving up and down like a playground swing. Swing traders jump in when it's low, hop off when it's high. The goal: catch a price move over a few days or weeks, not years. Swing traders focus on short-term trends, not long-term company plans. If a stock's at $50 and you think it'll hit $55 soon, you buy, wait, and sell at your target. It's active, but you don't need to quit your day job. Just a bit of research each day. You get more action than long-term investing, but without the stress of day trading. The key is spotting momentum. Jump in, ride the wave, and get out before the excitement fades. This approach can compound gains faster than buy and hold, making it appealing for those seeking quicker returns. Swing trading is about smart, timely moves, not marrying a stock, just dancing with it for profit. So, how do swing traders spot opportunities? It's all about technical analysis, reading charts for patterns. The candlestick chart is their go-to tool, showing price moves for each day. They look for trends. Is the stock moving up, down, or sideways? Support and resistance lines are key. Buy near support, the floor. Sell near resistance, the ceiling. Moving averages help spot the overall trend. If a stock's above its 50-day average, it's likely in an uptrend. Many traders only buy stocks above this line to avoid falling knives. Volume matters too. A price move with high volume means strong conviction. Weak volume, the move might not last. Think of volume as fuel for the price swing. These tools, charts, support, posture, resistance, moving averages, and volume, form the backbone of swing trading strategies. Mastering them helps take the guesswork out of trading. Let's see swing trading in action. Imagine Tech Corp, trading between $95 support and $105 resistance. A swing trader buys at $95, sets a stop loss at $92, and aims to sell near $105. The stock climbs to $104.50, so the trader sells, locking in a tidy profit. That's a textbook swing trade. Spot the pattern, manage risk, take profit, move on. But not every trade wins. Take Energy Co. It breaks above $30 resistance, so a trader buys at $31, targets $35, and sets a stop loss at $29. Suddenly, bad news hits the sector. The stock gaps down, blowing past the stop loss, and the trader takes a bigger loss than planned. This is the spill. Sometimes even perfect setups fail. The lesson: risk management is everything. Never bet big on a single trade. Losses happen, even to the best. The key is to stick to your plan, limit losses, and keep emotions in check. Swing trading is about discipline as much as strategy. Learn from every trade, win or lose. Swing trading offers the potential for quick profits and active involvement in your finances. You can trade around your schedule, making it flexible for most lifestyles, but the risks are real. Losses can happen fast, especially if a stock gaps down overnight. Emotional decisions, like chasing trades or panicking, can quickly erode profits. Trading isn't free. Commissions and time add up. It's not a passive hobby. You need to research, analyze, and manage trades regularly. Neglect your homework and you're just gambling. The real risk is underestimating the effort required. Swing trading demands discipline, learning, and commitment. If you're up for the challenge, the rewards can be worth it. Ready to try swing trading? Start with paper trading. Practice with fake money until you're consistently profitable. Treat it seriously. Keep a journal, track your trades, and learn from mistakes. When you go live, start small. Only risk what you can afford to lose. Focus on learning, not getting rich quick. Write a trading plan for every trade. Why you're entering, your entry price, stop loss, and profit target. Stick to your plan, no exceptions. A trader without a plan is just a gambler. Keep learning, read, watch, and study the market. Beware of get-rich-quick gurus. Trust reputable sources and your own experience. Review both wins and losses to improve. Be patient and disciplined. Success comes with time and effort.